But in the thick of earnings, let's address another set. And KFin Technologies, the CFO, Vivek Mathur, joins us on the show right now. Vivek, hi, great to have you today on ET Now. Thank you so much for taking the time out. Vivek, your numbers looks like a mixed bag, and I'm going to pick up the disappointment first because it seems that the margins have been a little bit amiss. I guess the pressure on yields working at that. Do you think the pressure is going to sustain all through the first half of the fiscal? Because I say that because there are no scheduled negotiations in FY25 that you've lined up.
Yeah, thanks. Hi, good morning. Thanks for hosting me on the show. On the margins, if you look at Q4 margins, they are ahead of 45%. And we believe that, it's a seasonal blip that comes in the first 2 quarters of the year because of, the usual increments that you give, but the corresponding revenue growth comes up in the later quarters. And that's why you see that the uptick will happen. So there is no negativity about the margins. It is only going to grow with the market supporting it. And we believe that if the market continues to do well, we will do upwards of 45% on a year-on-year, sustainability of the margins. And if our international, efforts work out well in this year, and 3 years down the line, we see the margins going nearing towards 45 to 50% range. If the market is not supportive, they will be in the 40 to 45% range.
Vivek, I want to understand on that last part of the point which you made, that you've been taking efforts to, go beyond Indian borders and also get a significant part of your business overseas, Indonesia to start with, some others. Tell us, what's the grand plan there? If we were to talk about the efforts that you're taking in the next 3 years, what percentage of your revenues would start coming in from overseas market? And also, are the yields and margins higher there? Because the premise you're making that your margins may have upward bias if all efforts fructify to almost 40%. What's the basis of that?
So if you look at the yields in Southeast Asia, our yields are 5.2 bips vis-a-vis 3.7 bips in India. And we have an escalation clause where we can actually increase our pricing, which is unlike what you do in domestic mutual fund clients in India. So we already have a headway because there is no competition in terms of outsourcing of RT activities in Southeast Asia. We believe today we may be having just 5% of our revenue, total revenue coming from Southeast Asia, and other international business put together about 10% of our revenue is from international business. We want to take it to upwards of around 20% with TA and fund administration business, not only in Southeast Asia. We are actively looking at acquisitions beyond Southeast Asia in Europe and US. So, currently we are in the process of setting up subsidiaries in Thailand and Singapore and Philippines. And once that is done, the parallel work which is going on in terms of M&A is to grow inorganically in Europe and US. And if you look at Indian market, the fund administrators get paid about 2.5 to 3 bips. But in the international market, it's anywhere between 6 bips to 25 bips. So there is a huge opportunity for fund administration business. Of course, it is competitive in international market, but I think we have been doing this business of managing funds and corporates and their backend activities for over 37 years. And with the growth in the AIF and international business over the last 3 years, we are confident that we will be able to disrupt that market and get the arbitrage of outsourcing fund administration to India. While international fund administrators are already present in India in terms of their captive being outsourced, there is no Indian company which has been able to set it up on a global basis. We want to be the first one.
All right. Morning, Mr. Mathur. And what about the compulsory conversion of Demat accounts in private companies? That's expected to kick in September this year. So what kind of incremental revenue, what kind of volumes are you expecting? What would be the market size for this?
So there is a huge opportunity on the issuer solution side to acquire clients because it is compulsory to Demat all the, even unlisted, corporates to have ISIN and shares to be in the Demat. So there is a huge opportunity. We expect, big FMCG companies who are currently, have in-house RTA business to outsource it. And we are pretty well positioned to win those mandates. We expect issuer solutions to grow anywhere between 15 to 20%. And with the growth in Demat accounts and number of folios going up from the retail participation, we expect that it will further fire up. So on a sustainable basis, mid-teens is a growth in issuer solutions, but because of these one-off opportunities which are coming up, it will go beyond 15% and can go up to 20%.
So, just to put it in perspective, the number of unlisted companies in India are, 3-4 times, in fact, 5 times plus, and many are getting emerging as well versus the listed universe. Can you share some light on how big an opportunity does it open for companies such as yours in terms of current volumes and targets and, the estimates which you have shared for 2-3 years ahead? This particular element, bumps up your estimates by how much?
So we are expecting that, if we get these mandates, it can certainly give a huge fillip in 1 year or 2 years. And we have seen that our growth in issuer solutions business had touched almost 35% in, a few quarters last year because of the burst in number of Demat accounts. So we do expect that, there will be an incremental impact in few quarters when we get these mandates, and it can touch anywhere between 25 to 30% growth. But on a sustainable basis, once it is stabilized over a period of next 3 years, the CAGR will be anywhere between 15 to 18%.
Okay, great. So how are you going to, because I read kind of a read through which I'm getting through with your commentary, that you are readying or at least analyzing the overseas market for strategic buyouts. Tell us, what is your framework? How are you identifying companies? Will it be big buyouts, or how are you preparing funding, etc.? Completely internal, or you have lined up some funding as the need arises?
Yeah, so if you look at our history of acquisition, they have not been large acquisition. We look at strategic acquisitions which make sense of, not 1 plus 1 is equal to 2, but, beyond 1 and 111. In terms of our clients in India getting benefit of that acquisition, and the overseas target acquisition clients getting the benefit of bouquet of products that we have. So we are not, we are cash surplus of 400 crores plus. And we believe there is enough dry powder that we have to do a mid-size acquisition, small to mid-size acquisition. We are actually looking at fund administration space where we feel that post-acquisition, it is going to be margin accretive because of our ability to run operations in a more efficient manner. The cost of running operations overseas is obviously much higher as compared to what we do in India. So we will use the opportunity of outsourcing IT and operations to India, and thereby leveraging and creating, operating leverage through the acquisition. So, at best, it may be 25 to 30 million US dollar kind of acquisition that we will look at, but depends on opportunity. We have been exploring, and we have let go of some acquisitions because we believe the value ask is much higher than what we feel it deserves. So we are not in a hurry. We are not on fire to acquire just because we have money. We will use shareholders' money very appropriately through a process of business development committee of the board, which reviews all the target acquisitions which comes on the table and what kind of margin accretive business we can generate by combining both and synergizing both the businesses.
Okay, thank you for taking time out and joining in. Good to have you on board, Mr. Mathur, giving us a view on how business is shaping up.
If you like this video, then like, share and subscribe to ET Now.